$4,200 an ounce. Not a price, a signal. Imagine waking one morning and discovering the system you trusted has quietly traded its promises for something colder, harder, and far older. Right now, nations are quietly stacking metal while markets argue over spreadsheets. Billionaires whisper, central banks move in silence. The Fed's last policy shift wasn't a minor tweak. It was a signal flare over a cage of unfunded promises. This is a story about trust breaking and about the thing that usually wins when promises fail. Gold, not a headline, not speculation, physical weight and history. From forced revaluations to the end of a monetary era, this pattern has repeated, always with ordinary people paying the price and a few who saw it becoming protectors of their wealth. In the next 40 minutes, we'll map the signal, trace the actors behind the curtain, and follow the trail from policy announcements to vault doors. We'll test the technical levels traders talk about, unpack the theory that could reprice everything, and show the simple, practical moves that separate those who survive a reset from those left guessing what happened. Listen closely. This is the signal most people are still ignoring. When a retail investor buys gold, the world barely notices. But when a central bank buys gold, the entire global financial system quietly shifts its weight. And in the last few years, that weight has been moving fast, away from paper promises and back toward the one asset nations reach for when trust begins to evaporate.
Are still ignoring. When a retail investor buys gold, the world barely notices. But when a central bank buys gold, the entire global financial system quietly shifts its weight. And in the last few years, that weight has been moving fast, away from paper promises and back toward the one asset nations reach for when trust begins to evaporate. Officially, central banks tell a simple story. They're diversifying reserves. It sounds technical, harmless, routine. But the scale, speed, and secrecy of their accumulation tells a different story. A strategic repositioning for a world where the dollar's authority is no longer unquestioned, and where geopolitical alliances are as fragile as the debts that bind them. This isn't investment. This is insurance. Sovereign-level protection. But the most revealing detail, isn't how much gold they're rebuying. It's who is buying. Nations that historically trusted the dollar system, Eastern Europe, the Middle East, Southeast Asia, have become some of the most aggressive accumulators. Countries that once relied on U.S. guarantees are now quietly building monetary escape hatches. They are not preparing for collapse, but for a transition, a world where financial power is no longer concentrated in a single reserve currency, but negotiated among competing blocs. And gold, as always, becomes the referee. Look closely and a pattern emerges. When global uncertainty rises, governments don't increase their holdings of tech stocks, bonds, or real estate. They buy weight. They buy permanence. They buy something no sanction can freeze, no central bank can print, and no algorithm can replace. This accumulation is not driven by fear alone. It's driven by foresight. Debt levels are reaching mathematical limits. Interest payments are swallowing national budgets. The promise that fiat currencies can remain stable while debts grow exponentially is unraveling. Central banks know the ending of this story. They've seen it before. Currency systems don't collapse suddenly. They decay slowly, then reprice violently. Which is why these institutions do not speculate. They prepare. The question isn't why central banks are buying so much gold. The real question is, what do they see coming that the rest of the world refuses to acknowledge? Because when the stewards of the financial system abandon the system's own promises, it means the quiet part of the global transition has already begun. When a central bank changes policy, most people just hear percentages. Markets hear probabilities. But insiders, the ones who've watched these cycles for decades, hear something else, a signal, because major policy reversals don't happen suddenly. They happen reluctantly. They happen when the internal math of the system stops working. For months, officials repeated the same script. Inflation is temporary. The economy is stable. Rates will stay high. But when the pivot toward cuts began, that wasn't a celebration. It was a confession. A quiet admission that something beneath the surface was straining. Rate cuts aren't always a sign of optimism. Cuts during strength are stimulus. Cuts during fragility are survival. This is why gold reacts before the public does. Gold doesn't wait for headlines, it listens to stress. The recent pivot wasn't just a policy change, it was a flare, signaling the system has reached a point where stability now depends on accommodation. And history shows that's when gold stops just following policy and starts exposing it. Thanks for watching. Every generation believes its financial system is permanent, unshakable, engineered too carefully to fail, and every generation is eventually proven wrong. The truth is simple. Monetary systems don't collapse, they get replaced. And each replacement follows a pattern so consistent it's almost mechanical. Look back at 1933. The US government didn't just revalue gold, it rewrote the definition of money to preserve the system's control. The reset wasn't chaos, it was choreography. Pressure built, trust faltered, and the authorities responded by changing the rules mid-game. Then came 1971. Nixon didn't TN the gold standard because he wanted a new era of economic freedom. He ended it because the math broke. Foreign nations were demanding gold faster than the US could supply it. Confidence cracked, and once again, the system rewrote itself to survive. Fast forward to 2008. When the shadow banking world imploded, central banks didn't let the system fall. They expanded it. Trillions were created from nothing. Liquidity became the new lifeblood. The world moved on, but at the cost of multiplying the very fragilities that caused the crisis. 3 different eras. 3 different triggers. 1 identical pattern. Trust erodes. Policymakers pivot. The monetary rulebook gets rewritten. Gold rises as the anchor of last resort. Resets are not dramatic explosions. They're transitions slow at first, then brutally fast. The public always realizes too late. The insiders always move too early. And gold always responds before the headlines explain what's happening. Today's conditions: record debt, fractured geopolitics. Weakening currency confidence mirror the prelude to every major monetary reset of the last century. History isn't repeating, it's rhyming loudly. Markets don't move because of news. They move because of pressure, invisible, layered, building long before anyone notices. And right now, gold sits in one of the most compressed setups of the decade. A coil wound so tightly that even a whisper of momentum could send it snapping upward. For months, price has hovered around critical breakout zones, levels where bulls and bears silently negotiate the future. These aren't just lines on a chart, they're psychological thresholds. Above them, skepticism collapses. Below them, confidence evaporates. And gold is pressing right against the ceiling. Every attempt to push it down has been met with stronger buying. Every dip has been absorbed by deeper pockets. That's not retail enthusiasm. That's institutional conviction. When giant hands enter the market, they don't buy for trends, they buy for transitions. Momentum indicators tell the same story. Long-term moving averages are curling upward. Volume spikes appear on green candles, not red. Even volatility, usually the enemy of stability, is tilting in gold's favor. Expanding during rallies, but contracting during sell-offs. That's the footprint of accumulation. And the most dangerous moment for bears is approaching. The psychological flip. It's the moment when too high to buy becomes too fast to miss. When traders who doubted the breakout suddenly chase it, pushing price even higher. Markets don't rise on logic, they rise on panic. The panic of being left behind. Once a major resistance breaks, the move that follows is rarely modest. It's emotional, explosive, self-reinforcing. A rising price becomes its own catalyst. Gold isn't waiting for confirmation. It's waiting for ignition, one final spark that turns pressure into motion, and motion into momentum. Every major monetary system reaches a moment when numbers stop making sense. When debts grow faster than economies, when currencies lose credibility faster than policymakers can patch them. When the promises that define modern money quietly drift into impossibility. And when that moment comes, nations don't default, they revalue. Revaluation isn't fantasy. It's a historical tool. A reset button. A way for governments to quietly reduce the real burden of their obligations without announcing a crisis. In the past, it meant raising the official gold price to match reality. Today, the theory is returning not because gold needs it, but because the financial system might. Think about the scale. Global debt has crossed levels that math, not politics, declares unsustainable. Countries now owe more than they can ever repay with stable currencies. The only way out is inflation, or revaluation. One is slow and painful. The other is sudden and strategic. The theory suggests this: if nations needed to anchor confidence, restore balance sheets, or stabilize collapsing currency trust, they could declare a new gold price dramatically higher than today, not to make investors rich, but to rebase the system. A higher gold value strengthens central bank balance sheets instantly. It makes impossible debts look manageable. It resets ratios that otherwise threaten collapse. Would it be controversial? Yes. Unprecedented? No. Every major monetary pivot in history included some form of revaluation. When fiat systems stretch too far, gold becomes the pressure valve, the silent absorber of accumulated imbalance. Whether or not such a move ever happens, the fact that serious governments are even modeling the scenario tells you everything. Revaluation isn't a prediction. It's a possibility, and possibilities shape markets long before they become reality. Here is the part most people ignore until it is too late. This entire story isn't about gold. It's about you, your savings, your purchasing power, your ability to survive a financial storm that's already forming silently, slowly, and then all at once. Because when currencies weaken, they don't announce it. They fade quietly. Groceries get a little more expensive. Rent climbs. Insurance jumps. You feel it long before the headlines admit it. And when currency trust breaks at the national level, ordinary families feel it first. Not central banks, not hedge funds, not billionaires. Regular people. That's why this section matters. Gold exposure isn't about chasing price targets. It's about preservation. It's about protecting years, maybe decades of work from a system that can change overnight. Look at every reset in the last century. The ones who survived weren't the traders. They were the people who hedged. And here's the truth. You don't need to go all in. You don't need vaults or offshore storage or stacks of bullion bars. Even modest exposure can make the difference between watching your purchasing power collapse and staying afloat. Physical coins, fractional bars, reputable ETFs, mining stocks with real reserves. You choose the mix. The point is simply this: be in the game. Because when trust erodes, diversification stops being theory. It becomes necessity. You insure your car, your house, your health, but almost nobody insures their money. Gold is that insurance, not glamorous, not hype. Just a 5,000-year constant in a world built on variables. And here's the final question. If central banks are preparing, if billionaires are preparing, if history is repeating, why would the average person wait? When the reset comes, those who prepared won't be shocked. They'll be ready. Before you click away, remember this: you're living through a turning point. Not in theory, not in headlines, in real time. The signals are flashing. Central banks are buying. Governments are pivoting. Currencies are weakening. And the world you grew up in is shifting. Most people won't see it until it hits their paycheck, their rent, their savings. But you're not most people. You're still here. You're paying attention. And that already puts you miles ahead of the crowd. So here's what you do next. Hit subscribe. Because this channel is not noise. It's not hype. It's not clickbait. It's a map, the kind you only realize you needed after the storm arrives. When the next reset fires, when the markets snap, when the headlines turn red, you won't have time to research. You'll need a signal you can trust. That's what this channel delivers. So subscribe. Turn on notifications. Join the people who refuse to be blindsided, because the world is changing fast. And the ones who see it coming, they don't just survive. They rise. Your next episode drops soon. And it may be the most important one yet. Stay alert. Stay informed. And above all, stay ready.